Welcome back to The Deep Dive, the show where we try to turn all that financial complexity into some pure, actionable insight for you. We take the latest reports, all the market chatter, and we just deliver the knowledge you need to be truly informed. Today, we are doing a high-octane follow-up, a deep dive into Genting Malaysia Berhad, or GENM. Now, if you remember our analysis after their Q2 results, and you can find that link below, we highlighted a company showing some serious operational recovery. But now with their Q3 2025 report, which just dropped on November 27th, that recovery is, well, it's undeniable. Yeah. But it's also completely overshadowed by this accounting paradox.
Huge revenue growth on one side.
Exactly. And a catastrophic reported profit crash on the other. It makes no sense on the surface. So our mission today is threefold. First, we need to strip away all that technical noise to really understand GNM's true operational health. Second, we have to analyze the bizarre, high-stakes drama around the privatization offer from the parent company, Genting Berhad. And finally, we're going to determine if that 2 ringgit and 35 cent offer price is, as a lot of people are suggesting, a massive undervaluation given what's looming in New York. And, hey, if you rely on us to distill this kind of complexity, please do us a solid right now. Hit that like button, and please subscribe to the YouTube channel. It really does help us reach more listeners like you.
You know that paradox you mentioned, the strong top line with the profit collapse, that is the absolute defining feature of this report, and it says so much about the company's underlying structure. But maybe first, let's quickly frame the business for anyone who might be new to GNM.
Good idea.
So GENM is a global leader in leisure and hospitality. But they don't just run casinos. These are integrated resorts. We're talking gaming, high-end hotels, massive food and beverage outlets, theme parks, retail, entertainment, the whole package.
Right, and that model, it requires just a massive amount of capital, which itself provides a huge barrier to entry. That's key to their whole position, isn't it?
It is. That's the moat, really. And we can break their world down into 3 critical geographical segments. You've got the flagship, Resorts World Genting, or RWG in Malaysia. That's the cash cow, the stability provider. Then you have the established operations in the United Kingdom and Egypt. And finally, the really strategically vital, high-potential segment in the USA and the Bahamas. And that crucially includes Resorts World, New York City, RWNYC, and the recently consolidated Empire Resorts assets.
And because of all the heavy costs, like depreciation on these huge complexes, management uses a specific metric to measure performance, right?
Exactly. They lean on adjusted EBITDA. So that's earnings before interest, taxes, depreciation, and amortization. It's the key internal metric. It tells us how well the actual resorts are making money day to day, before all the financial engineering or accounting swings.
And in this report, paying attention to which EBITDA figure we're looking at is absolutely essential.
It's the whole story.
Okay, let's unpack this paradoxical report, starting with the biggest win here, the revenue growth. When we look at the first 9 months of the year year-to-date September 2025, GNM's total revenue was nearly 8.9 billion ringgit.
Yeah, RM 8,871.5 million to be exact, and that's a really solid 8% increase compared to the same period last year. For those who followed our Q2 deep dive, this really shows that the post-pandemic recovery, which was, in full swing mid-year, didn't lose any steam. The momentum is very, very real.
And you can see just how important that core business is.
Oh, absolutely. The leisure and hospitality segment alone generated nearly 8.7 billion ringgit of that total. And the engine driving all of that, pure gaming revenue, almost 6.5 billion ringgit in 9 months. So this confirms the business is recovering everywhere and the core gambling operations are seeing more people and higher volumes.
Okay, but now for that whiplash moment we talked about. The Q3 results in isolation. While Q3 2025 revenue surged by a massive 22% year-on-year, hitting 3.35 billion ringgit.
The net profit dropped by an astonishing 79%. It just plummeted to only 119.7 million ringgit.
To the casual observer, that looks like an operational failure. But the segment breakdown, it tells a much, much healthier story.
It really does. The core operation is not failing at all. It's actually the strategic expansion and external factors, especially currency volatility, that are just dominating the reported bottom line. Let's look at where that revenue growth actually came from in Q3 versus last year.
Okay, starting with the flagship. Malaysia's Resorts World Genting.
Revenue there surged 19%. It crossed the 1.99 billion ringgit mark. And management attributed this directly to higher business volume, mainly in the gaming segment.
So they're getting more people through the doors and they're spending more.
Exactly. And what's really encouraging for any long-term investor is not just the volume, but the efficiency. The adjusted EBITDA margin for the Malaysia segment actually improved to 31% in Q3. That's up 2 percentage points from 29% last year.
That might not sound like a lot, but on that massive revenue base,
Yeah.
that's a sign of really exceptional yield management and cost control.
That operational discipline is fundamental to their success. It's their anchor.
Okay, moving across the globe, the U.S. and Bahamas segment. This delivered the most headline-grabbing growth.
Oh, for sure. Revenue shot up a massive 64%, landing near 774 million ringgit.
Wow. And what's behind that?
This is a clear payoff from the consolidation strategy we talked about after Q2. That massive spike is mainly from the full consolidation of the Genting Empire Resorts LLC, or GRL Group. That alone contributed over 330 million ringgit in revenue for the quarter. Remember, they bought the remaining 51% stake back in May.
Right. So now at full control, they're getting the full scope of that revenue.
Precisely. And even with all the integration and restructuring costs that come with that, the segment's adjusted EBITDA still increased by a solid 22%. The U.S. segment is really moving from a strategic bet to a core revenue driver.
And what about the UK and Egypt?
A more modest story there, but still strategic growth. A 2% revenue increase to 546.6 million ringgit.
But the story there is a bit more complex, isn't it?
It is. The new Stratford Casino in London, that acquisition contributed growth, but some of that was, eroded because the ringgit strengthened against the pound sterling.
So foreign earnings translate into fewer ringgit on the books.
Exactly. But the real challenge there is profitability. The adjusted EBITDA for UK and Egypt actually decreased by 17%.
Ouch. Why so much?
It was due to lower business volume in some of their established properties and significantly higher operating and payroll expenses. It suggests that segment is still wrestling with post-acquisition costs and just general inflationary pressures.
Okay, now let's address the most confusing technical point in the report, which is that sequential trend. Q3 versus Q2. We know overall revenue was up 15% sequentially, which is great momentum. But the group adjusted EBITDA fell 19% sequentially. It went from over 1 billion ringgit in Q2 to 838 million in Q3.
And this is the part that misled a lot of analysts. It's a classic case of accounting noise versus operational reality.
So break it down for us.
As we just established, the segment-level adjusted EBITDA for Malaysia, for the US, for the UK is growing strongly. The group-adjusted EBITDA figure, however, that includes results from the really volatile investments in others segment.
Right.
And in Q2 2025, that group figure was heavily boosted by some significant non-recurring accounting gains, specifically a large one-off gain on the disposal of an asset, which they recognized at over 77 million ringgit. Q3 just normalized. It didn't have any of those large non-operational gains.
So to put it simply, the 19% sequential drop in group EBITDA wasn't a sign that the resorts started performing worse.
Not at all.
It's just that the one-time non-core accounting boost from the last quarter disappeared.
Exactly. The operational engine didn't fail. The extraordinary accounting noise just stopped.
Yeah.
If you remove that Q2 noise, the core operational run rate for Q3 is robust. And that is such a critical distinction. It's why you can't just take the headline numbers at face value.
Okay, now that we've sort of quarantined that operational strength, let's talk about the real black hole that's swallowing the reported net profit, foreign exchange volatility. This single non-cash factor is responsible for that dizzying 79% collapse.
This is GENM's Achilles heel. It's their single greatest financial structural vulnerability. The company has substantial borrowings denominated in US dollars, debt they took out to finance their expansion in the US and other markets.
And because of accounting rules, the value of that debt has to be translated back into ringgit on the balance sheet every single quarter.
Exactly. And those translations result in unrealized paper gains or losses that flow directly into the profit before taxation, or PBT.
Right, non-cash. No money is actually changing hands. It's just an accounting requirement.
But the impact on the reported bottom line is absolute. It's huge.
And the swing between Q3 of last year and Q3 this year was monumental. It basically flipped the script and wiped out nearly 600 million ringgit in reported profit.
Precisely. Just look at the data. In 3Q 2024, the ringgit was weak. That resulted in a massive net foreign exchange translation gain of over 601 million ringgit.
So that paper gain heavily inflated the reported profit for that quarter last year.
Right. Now, fast forward to 3Q 2025. The ringgit strengthened against the US dollar during this quarter, and that caused that same line item to plummet to a meager gain of only 2.8 million ringgit.
So nearly 600 million ringgit in non-cash profits just vanished.
That's the arithmetic reason the net profit fell 79%, even while core revenue was surging 22%. It's a phantom limb of profitability. Present one year, gone the next.
So let's do that operational health check again, but this time stripping out all that noise.
If we exclude those massive Forex gyrations, the true underlying operational adjusted EBITDA actually increased 19%. It rose from about 703 million ringgit to 835 million ringgit year over year. This is the number management uses, and it shows the resorts are performing brilliantly.
That 19% underlying growth is a signal the market needs to be focusing on.
It is. It confirms that the extreme earnings volatility is introduced entirely by the balance sheet structure and currency risk, not by the competence of the operators. Management's doing a great job running the resorts.
Which raises a strategic question. If this debt introduces so much volatility, why not just hedge the currency risk completely? I mean, even if it adds some cost.
That's the multi-billion-dollar question, isn't it? Full hedging is expensive,
Yeah.
and it also caps your upside when the ringgit is weak, which, as we've seen, can give them these massive non-cash gains.
So they're making a trade-off.
It's a high-stakes trade-off. They're accepting high earnings volatility in exchange for the potential for these huge gains when currency markets move their way. But, I mean, the recurring nature of these huge swings, both positive and negative, it really suggests the current level of financial risk is actively suppressing the company's valuation multiple. It just makes the reported earnings so unpredictable.
And beyond the Forex drama, the group is also grappling with some very real cost increases tied to, high interest rates in their acquisitions.
Yes, that debt load of over 13.1 billion ringgit is materially more expensive now. Total finance costs for the first 9 months of this year increased by 73.7 million ringgit.
And that's a direct consequence of higher interest rates after they refinanced and issued new notes.
Right. So servicing the debt is just eating a larger chunk of the operational cash flow. Simple as that.
And the restructuring costs are an immediate headwind, too.
Absolutely. The group recognized an additional 22.2 million in redundancy costs year to date. It's painful, but necessary. It's linked to two main things: restructuring the acquired Stratford casino in the UK and redundancies in the US as part of streamlining after the full GRL acquisition. Short-term pain for long-term gain.
Right. And there was a small one-off accounting cost from the GRL acquisition itself.
Yeah, an 11.9 million ringgit net loss on deemed disposal of associates. Just a technical accounting adjustment.
Okay, so finally, a quick look at the overall cash position. Despite all this noise, the actual cash generated from operations is still pretty robust.
It is. Cash flow from operating activities is strong at almost 1.8 billion ringgit for the 9 months. This is the real money generated by the resorts, and it's supporting their aggressive investment strategy. They've already poured over 600 million into property and equipment this year, and their authorized capital commitments are massive, nearly 3 billion ringgit. So management has faith, but they're burning cash to build future scale.
Let's pivot now from the financials to the corporate drama, because this Q3 report landed right as the parent company, Genting Berhad, or GENT, was pushing hard to finalize its privatization bid for GENM. This maneuver, it introduces intense governance risk and creates a really immediate dilemma for minority shareholders.
The timing is absolutely critical. GN initiated a conditional voluntary takeover offer on October 13th, seeking to acquire the remaining 50.64% of GNM they didn't already own, and the price was 2 ringgit and 35 cents per share in cash.
And GENT wasted absolutely no time acquiring control.
That's right. The offer became unconditional on November 3rd, and since then they've triggered a mandatory takeover offer, so they're obligated to follow through. Crucially, as of November 26th, GENT holds a commanding 63.36% direct interest in GNM. The closing date was then extended to December 1st.
But the market reaction to this is it's bizarre. The stock price has been consistently hovering above the RM2.35 offer price. It's been trading at RM2.36, even RM2.37.
Which is extremely unusual.
Right. In a takeover where the buyer's offering cash, that just doesn't happen.
What the market is doing is pricing in an imminent, high-probability event. an event that GENT is desperately trying to acquire before it materializes. Any investor who's buying shares at RM2.37 is explicitly rejecting the RM2.35 offer. They are signaling that they believe the company's fair value, driven by that New York casino license, is significantly higher than what GENT is willing to pay.
It's a classic battle of corporate opportunism versus market expectation.
It is, and GNT's official motivation for all this is tied directly to that New York catalyst.
They said it's to strengthen and better support their bid for the mega casino in New York.
Right. Consolidation lets GNT present a unified financial front. It streamlines investment decisions for that $5.5 billion project, and it removes the friction of dealing with minority shareholders. They want full control before the big announcement.
But the valuation discrepancy here is the core issue of fairness. I mean, the independent advisor literally deemed the RM2.35 offer not fair.
Not just not fair. They said it represents a deep discount of between 32 and 37% compared to GNM's estimated fair value range.
Which they pegged at what?
Between RM3.48 and RM3.77 per share. That is a huge gap.
So the independent advisors, they're looking at things like discounted cash flow models, which would have to factor in the high probability of winning that New York license.
Absolutely. They're looking at the future earnings potential, and that analysis is telling them the offer is an aggressive attempt to acquire the company on the cheap, essentially capturing all that New York upside for GNM, not for the minority holders.
So if you, the listener, are currently holding GNM stock, what is the consensus? Should you hold on or take the discounted deal?
The market is completely split. It just reflects the massive risk-reward calculation here. On one hand, you have cautious voices like HLI who advise shareholders to accept the offer.
And their reasoning was focused on the persistent structural challenges, right? The profitability drag from Empire Resorts, the cost pressures in the UK.
Exactly. They maintained a target price of RM2.35. They're betting on caution over catalyst.
But on the other hand, the vast majority of the bullish market is holding firm.
They are. Other analysts have target prices reaching up to RM3.27. CGS International, for instance, they upgraded the stock to hold, raising their target to RM2.46. They view a successful privatization at this low price as pretty improbable because the New York upside is just too substantial to give up.
So the conclusion for any shareholder is clear. By accepting RM2.35, you get cash now, but you forfeit the potential multi-billion-dollar reward.
And by holding, you bet against the parent company and on the New York regulators. It's a huge gamble.
Okay, so this tension we've established, poor reported profit versus a high market price, it's all rationalized by these forward-looking catalysts. Let's break down the factors giving the market such immense confidence.
The single most important factor, the one fueling this entire privatization drama, is the New York casino license. This is the immediate game-changing catalyst.
And the timeline is incredibly tight. The New York Gaming Facility Location Board is expected to announce the winners for the 3 downstate licenses by December 1st.
With formal licenses issued by the end of the year. So this decision is literally happening as the privatization offer expires. The timing is just incredible.
And GM's proposal is immense. A $5.5 billion transformation for Resorts World New York City, which is currently just a slots-only facility.
Winning this license would instantly give them full commercial casino rights, including table games, in the single most valuable gaming market in the U.S. outside of Nevada. It's a monster prize.
Yeah, and CGS International called them a shoe-in. Why such confidence?
It's based on a few things. First, the location in Queens is key. It accesses a huge established market. But most importantly, RWNYC already exists. It's a huge operational facility.
Unlike competing bids that need years of construction.
Exactly. CGS projects that if they win, table games could be operational by July 2026. That means the return on that investment could start flowing almost immediately.
The second catalyst is the ongoing structural enhancement within their U.S. operations, the GERL consolidation.
Full ownership is crucial. It allows for genuine operational synergy. Management can now maximize cross-marketing, resource sharing. It just fundamentally enhances their footprint in the northeastern U.S. gaming market.
And the financial restructuring in Empire Resorts is a huge positive. It addresses one of the core profitability concerns we raised back in our Q2 deep dive.
This is a vital cleanup. Empire is finalizing a proposal to sell non-gaming assets for $525 million. They plan to use $300 million of that to redeem high-interest debt. This is a direct, tangible move to strengthen Empire's capital structure and reduce that financial drag that analysts like HLB are so worried about.
And finally, we shouldn't overlook the continuous smaller-scale enhancements to their established resorts.
Right. In Malaysia, they're investing to keep the flagship fresh. The new ecotourism attraction, Euphoria, is set to open next year, and they're revamping the golf course at Resorts World Awana.
All timed for the Visit Malaysia year 2026. Smart.
Very smart. And in the UK, they're benefiting from legislative changes that permit more gaming machines. They're already rolling those out, which provides a nice incremental high-margin revenue boost.
Okay, so we have undeniable multi-billion-dollar upside potential. But on the flip side, we have three material red flags that intensify the risk. What are the warnings?
Number one, and we have to keep coming back to this, is the foreign exchange volatility. The sheer magnitude of that 600 million ringgit swing in unrealized gains and losses makes reported KT fundamentally unpredictable.
It's just a structural issue that introduces perpetual instability.
It is. The second warning is the combined weight of high debt and rising costs.
That 13.1 billion in borrowings.
With that much debt, the 73.7 million increase in finance costs is material. High interest rates make that debt load significantly more expensive, and that constrains cash flow.
And finally, that lingering legal risk.
Yes, the unresolved litigation involving Resorts World Bimini is still active. The other party is seeking damages in excess of $600 million US.
Wow.
And while GAI has had some success getting initial complaints dismissed, an amended one was filed. It remains a significant unresolved financial uncertainty. A lawsuit that size introduces headline risk you just can't ignore.
All right, let's bring it all together with our financial Moat scorecard. In our deep dive on GENM's Q2 results, we assigned it a score of 5 out of 10. That score reflected caution, due to the unresolved profitability issues in the US and UK, the integration risk of GRL.
Right, and just the general volatility.
So given the operational momentum we've seen, the successful consolidation of GRL, and this imminent potential of the New York license, we're now increasing that score.
The current assessment for Genting Malaysia is a robust financial Moat score of 7 out of 10. This 2-point jump reflects the materialization of those strategic benefits and the growing certainty that their biggest catalyst is about to pay off. The operational story has clearly strengthened.
So let's detail the foundation for this 7-10 score. Where does the intrinsic competitive advantage really lie?
It lies in two structural high-barrier advantages. First, intangible assets, specifically regulatory protection and exclusivity. Gaming licenses are political, they're capital-intensive, and they are incredibly scarce. The fact that they hold key licenses in Malaysia, the UK, and are positioned to win one of only 3 in downstate New York provides a legal and regulatory moat that's virtually impenetrable.
And second is just the sheer scale.
The sheer scale and capital requirements. To compete with GENM, a rival would need colossal capital. Their ongoing capital commitments of nearly 3 billion ringgit show the scale required just to maintain these empires.
So if the structural moat is based on such unassailable barriers, regulatory protection, and massive scale, why is the score not higher? Why not a 9 or a 10? Why temper it back to a 7?
Because the strength of that operational moat is critically undermined by financial and external vulnerabilities that management, they just can't fully control.
And that starts with the financial volatility.
Yeah, it does. We have to come back to it. The operational excellence is constantly masked by the balance sheet structure. That extreme exposure to non-cash Forex risk ensures that reported earnings will remain unstable and unpredictable.
And second, the immediate risk tied to governance and litigation.
We have that unresolved material $600 million litigation risk. That's a major financial overhang. But more immediate is the governance risk highlighted by this privatization attempt. The parent company is actively pursuing control at a deeply discounted price.
35% below the independent advisor's fair value.
This aggressive maneuver, timed precisely before the New York decision, suggests a risk of minority shareholder value extraction. And while that's not a moat killer, it introduces a necessary discount to the final score.
So the 7 out of 10 is a strong operational business that has finally streamlined its U.S. assets and is on the verge of a massive catalyst.
But that potential remains constrained by structural debt issues and aggressive corporate behavior from its majority shareholder.
That makes a lot of sense. The improvement from 5 to 7 recognizes that the integration risks are largely done, the Empire drag is being addressed, and the operational performance is exceptionally strong.
But the financial headwinds and governance concerns, they keep the ceiling firmly in place for now.
So this deep dive into Genting Malaysia's Q3 report, it really reveals a company at a critical inflection point. The operational momentum is undeniable. Adjusted EBITDA is up significantly. But this success is just completely obscured by these massive non-cash currency swings.
And overlaying this financial tightrope walk is the immediate high-stakes privatization drama. GENT is pushing to finalize its RM2.35 offer, an amount deemed not fair by its own advisor. And the stock price hovering slightly above that offer price tells the full story. The market is betting heavily that GENT is trying to acquire the company right before that decisive New York casino license decision.
So the ultimate fate of that 235 offer, it rests entirely on whether the market believes that multi-billion-dollar license potential is already fully priced in, or if it represents a significant immediate opportunity that minority shareholders should absolutely hold on to.
It's the definition of a value versus catalyst gamble.
Yeah.
And it's one that's going to be resolved within days of this analysis.
Thank you so much for joining us for this in-depth look at Genting Malaysia. We hope this has given you the clarity you need to navigate the volatility and the massive catalysts driving this stock right now. We sincerely appreciate you tuning in. If this analysis helped you cut through the noise, please let us know by hitting that like button and comment below. Tell us your thoughts on the RM2.35 privatization offer, or maybe what stocks you'd like us to cover next. And of course, subscribe to the deep dive for more rapid, detailed analyses. We'll catch you on the next one.